First and foremost, it was Dow 20K for the first time ever. We did really get close to it, though, a couple of sessions ago, which I actually kind of just counted as Dow 20K. If you take a look at the DXJ, it actually had hit 200, and this was the day that the Dow missed it by like, I don't know, 33 cents, something insane. A couple of sessions ago. When was this? It was 1-6. The high of the day that day was 200. So I had just taken that as basically being Dow 20K, but of course we needed to do it officially so everyone could cheerlead. The Dow up until then had been really just chopping around. It put in a basically the highs were poor, and you had a multi-day, really, let's see, how many days? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 1, 22, 23, 24, 25, 26, 27, 28. Basically like 28 plus, almost a month worth of consolidation. And you had a lot of catching up. The 10-day is all caught up. The 20-day is caught up. The 50-day is really not that far below. And today was technically a breakout, a gap, what could be considered a gap and go, a professional gap. The key on gap days, like these breakout days, and I'm always leery of gap days because they can sometimes be head fakes or they could have continuation. So what you'd really want to see is at least half of today's move hold at the very least. If you start getting below today's low of day, I could say that this might have been a look above range and fail, which I'm always cautious about. The same kind of a setup, actually, I always like to think, just the way I think, I mean, some people think differently. I don't know, maybe I'm just negative with how I think about things, but I always like to think about what the worst case scenario is, what can go wrong. Same kind of a thing in Boeing today. You had this kind of, I wouldn't say it was more of like an exhaustion type of a gap, one that gapped up and continued going above range after a move that already run. But my big beef with calling it that is the fact that we've had this multi-week consolidation. So it's not like it was just this straight up move with this big kind of gap at the end of a move. You've had a lot of consolidation. So with a stock like Boeing, you don't want to see it give up much of the intraday range. Today's VWAP was 167.25, so you want to kind of stay above there. If you start losing halfway of today's bar, it gets a little iffy, and if you lose the low of day, to me, it would be an outright short. So always keep those kind of things in mind, just because the media is talking about how bullish Boeing is, and I'm not going to say that this chart isn't bullish. It is super bullish, but keep in mind we've come up a long way already, and this sort of breakout could be more of the one you want to book some profits into, and then if you like it, maybe buy it on a dip. I mean, keep in mind that Boeing in February was barely holding on to 102. It consolidated for a while, and this rally didn't, just kind of start. It started in September, and we're up basically 40 some odd points, so it's hard to, today, in my view, first start getting crazy bullish in Boeing. A couple of things to note. I always like to watch volume. Usually at the end of moves down or at the end of moves up, the volume accelerates ginormously. It's the capitulation on the way down as well as the capitulation on the way up. And today you did have a rise in volume. I think about volume a little bit differently than kind of the people you'll hear on television. They always say that they don't believe a move unless there's a lot of volume. I love rallies that happen on low volume when I'm long because that means there's not a lot of participation. It's not a crowded trade. Think about it like you would be in a rowboat. If you have a lot of volume in the boat, it starts sinking the boat at some point. You can only have so many people into it. And I think that a lot of people think that they need this volume to confirm, but for me, it's kind of the opposite. When I start seeing the participation, when I start seeing people getting really bullish, when I start seeing these kind of very quick moves, I'm starting to think we're getting closer to the end of the move, and it's always the end of a move is always the fastest. You know, when things are going straight down, those like, you know, gut-wrenching days, that can't sustain itself. It's like a breakneck pace. The same thing with the move up. So I'm starting to, you know, look for places in these stocks to book profits, or to maybe start now first looking to get into short. Speaking of shorts, one of the things that kept me out of really being short the market, and I know a lot of people are still fighting, has been the internals of the market. I'm going to go over this a little bit more in the weekend review video, so I can tease you guys up a little bit for that. But I've mentioned the last few days, and all throughout this rally, it's been the same. You've had these weak internal pullbacks, and when I say weak internals, I don't mean that the market is weak. I mean that the pullback is weak. You have like -1 to like -1s, -2s, -3s max. And the other day when they were trying to pull the market back, you were doing it with basically almost positive internals. I think there was one day that had really massive negative tick distribution, and then and that was like, it was like nothing. I mean, it was like a mosquito bite for this type of a market. It really wasn't that impressive of a move down. What I need to see, and I'll tell you, what I needed to see was multiple distribution days. You know, often the declines start, and they start out mild, and that's the, I guess, institutions unloading because they still have, I guess, retail who is interested in purchase. And that doesn't culminate in a day. Think about this. If you had millions of shares to sell, you have to do it over time, or else, you know, your selling will put the price down further on you. So these guys, when they come in, they tend to do it, you know, from morning till close throughout the day. They sell a little here, they sell a little here, they sell a little here. It's not like all in the last 30 minutes of the day like day traders do. So you can get an idea of who is running or who's in a market at any given period of time. If you're seeing really negative internals, you just see the bid being sat on, you know, those trend days, either up or trend days down. In this instance, I'm talking about a move down. You'd see like no positive ticks. You'd have multiple 1,000, down 1,000 ticks, and you'd have like these horrific internals. You wouldn't have, you know, they're really sort of, nothing escapes. It's like the absence of light. It's like the black hole, that vortex. You just see everything coming down. But before that happens, there's often signs of multiple days of more mild distribution. And we had, in my view of that, maybe 1.5. I could say 2 if I'm being generous, but it was like 1.5. And I think the ticks really kept me, and I hope people who were following, who I kept on mentioning the ticks the last few days, out of trouble. And I'll tell you why. If I have to rank sort the internals that I watch, it is the ticks are first. They're sort of like the quickest one to shift, and that's why I watch them. Then there's the advanced decline lines, which is when you sort of think about, let's do it Navy kind of style. The ticks are sort of like the speedboats. The AD line is kind of like, I guess, the battleship maybe, and the breath is like the aircraft carriers. These don't turn on a dime so quickly. The ticks turn quickly, so you could see what's going on quicker there. Often that's where trouble or good things sort of begin. That's where the magic happens. So I wasn't seeing the breakdown in any of these indices, in any of these internals. The VIX also wasn't skyrocketing. You had days that, you know, were kind of just listing lower, and the VIX might pop, but I mean, you couldn't even really get over like 12s and 13s. For me to see things that would drag me into shorts, I need to see multiple points of data that, same thing for longs, multiple points of data that get me to kind of shift. And I often am looking for these things at market bottoms too. And at some point we'll be having this discussion after, you know, some kind of horrific market move down. It's kind of the same thing. So that really was the I guess, the internal that really told the tale. And how to use the ticks. Let me explain. First of all, it's $TICK if you're on Thinkorswim. What I do is I draw a line over the 0 point, like I have a blue dotted line, and then at a positive 1,000 I have a line, and then at negative 1,000 I have a line. And the negative 1,000 is usually, for some reason I have it green, the top one I have as red. And I look to see how many times each gets touched, because that's kind of confirmation. But more importantly, I look to see where the body of the tick, and I use, let's say, a 2-day 15-minute. I wouldn't use anything less than a 15-minute for this. I look to see where those bodies close. How many above the 0 line, how many below the 0 line, and at the end of the day, I look at 26 bars, what the distribution looks like. And you could kind of see throughout the day, are the bodies are they getting higher? Are the tails getting higher? Or are they getting lower? You could kind of see the trend of which way the day is heading. And that, to me, is a very valuable piece of information. So now that we got that internal through, and this, by the way, is what kind of kept me in long positions. However, and I teased this up in a tweet leading into today, I talked about IV being super low. You have one of my followers brought this to my attention today. This SVXY. This thing has gone parabolic. It's the kind of the antithesis of. It's the kind of the opposite of the VIX. It's like a levered. It looks like a levered move of short volatility, and this thing is just straight the F up. I mean, it's incredible. If you do a 1.618 Fibonacci extension, it could maybe get to 140, but I mean, who knows? I mean, I don't really not honestly know how technicals work with these things. I don't really follow them that much, but IV is getting pretty low. So I had talked about a play on SPY as either a directional short, or more importantly, as a hedge against longs. If you're worried, it's always good when something's cheap like volatility. It's always good to use as at the very least, a hedge against long positions. So how to go about that? Buy VIX, buy one of these levered ETFs. Not for me. What I do is I play with SPY and SPY Premium. And the trade that I had espoused at the time was, let me look. I still have it on in one of my accounts here. It was in the February expiration. It was long 125 puts, short 220 puts, and an overwrite of short 211 puts in the same expiration. Obviously, the play is down. It's not a winner, but it's not a zero either. Today, I talked about rolling that out to get more time on it. I probably should have done this yesterday because I did think today would be up, actually, oddly enough. We had a close for the first time over the Fed day high. Remember what I've been talking about the last couple. This should have been no surprise to anyone today, by the way. Last night I was actually out to dinner and I was talking about the market, and I said I like that we had the first close over the Fed day high, and I expected today to be a gap up. The Fed day high was 2272.5, and yesterday was the first time ever we had a close above the Fed day high. That put range extension into play, and boy did they extend it today. This could have actually been even far worse, in my view. The internals today, though, on the rally were fairly mild. They were only in the 2-to-1 positive, and I think it's because people are afraid to jump in, being that the market is so high. So what did I decide to do today? I know that theta isn't in my favor here. If you don't know what I'm talking about, this is how options are priced in. I actually took some fairly sophisticated courses in college about options pricing, and oddly, it came very naturally to me. Big surprise, right? So you have delta, gamma, theta, and vega. These are the important parts of options pricing. If you're, I'll just briefly explain what these are. Delta is the amount that the option switches per dollar of increase. Gamma is the amount that the delta changes. It's like the first derivative of delta. So that, like, after the dollar goes up, that's how much the delta will change. Theta is the time decay, and vega is the volatility exposure. Volatility here is the key. There are two components now that I see with the low IV situation that we're in that are the big risks in terms of either being short premium, and I'm going to talk about this in a minute in Google, because somebody asked me, is it time to short puts in Google? And I think my answer to that might be a bit of a surprise to people. So the risk is gamma and vega risk here, meaning that you get a sharp move down, which will jack your deltas, and the vega going against you will jack the vega pricing. So if you're short premium, you could get, wackarood. If you're long premium, you get two things going for you, both directionally and the IV. That, let me tell you, I've learned this lesson over years of trading. When IV is low, don't be short. Either don't be short premium or be short in smaller size. Size is what kills you. And when you have both price and volatility going against you, it's very, very, very painful. So price matters. Keep that in mind. One of the mistakes I think I used to make when I was a younger man was I'd always have to be fully invested in the market. If I wasn't at my max margin, I was missing out. I should be making more money than I am. I'd be pissed, and I'd need to always have that. What you need to realize is that at any given point in time, you can really blow out your account very quickly if you, first of all, don't know how to defend yourself, and two, are always at max margin, because something will always wind up punching you in the throat. There'll be a terror incident. There'll be something that goes wrong, and there's a big gap down, and then you're kind of effed. So you never want to be at max margin. I always say that your capital and your margin are like your fuel. Your capital is your fuel, and your margin is your ammunition. And if you run out of either, you are dead meat. That actually came from a famous 80s movie, Iron Eagle. That's Chappie's words to Doug before they go over the border. You never want to run out of fuel or ammo, or you are dead meat. And I assure you, I've experienced this, unfortunately, more times than I would have liked. You're always going to be forced out of something when you don't want to be. The market, I will tell you, it has an uncanny way of going further and longer than you can stay solvent. What seems reasonable at the beginning, and what seems like almost incomprehensible, winds up happening. That's often, like I was saying, the IWM, I thought we'd see 138s, and this was even before IWM broke out. People told me I was nuts, but I understand how price moves. I understand momentum. And the truth of the matter is that price gets to a level not because it's rational or logical, it's out of necessity. When you have price going in your direction or against you, you have two things going for you. One is the underlying conditions of the situation, and two, the people who are wrong. And those people don't always capitulate very quickly. So often you'll get exaggerated moves, and it's all very quickly these days with algorithmic trading and all kinds of stuff, shenanigans that go on in the market. I could tell you, moves that used to take weeks and months, particularly in currency, can happen overnight. It's actually quite stunning. So always keep that in mind. That's a little bit of risk management. I'm actually going to be working on a follow-up to my much-beloved risk management video, by the way. So let's get into some of these stocks. First and foremost, let's address Google, because I kind of teased it up earlier with that premium question. So let me pull up the chart of Google. If you're following along, you could do the same. I had talked about that I thought Google would go higher. Anything over the high I thought would run. There is a 1.618 Fibonacci extension up at 895.44, and the channel high is up close to, if it were to do it tomorrow on earnings, is up at 916. The expected move for Google is about 30 bucks, which is low for, I think, for Google. Google has a tendency, like here's another little trick. Pick a narrow set of stocks. If you want to get an idea of what I'm talking about this like two-step, see that movie Hitch where he's doing the dance scene, the guy's doing all these crazy moves and he smacks him and he says, this is you, this is your space, your zone. That is me, believe it or not. I stick to a very narrow set of stocks. I learn their personality. I learn how they're supposed to behave. And when they don't behave that way, I know what to do. And when they do behave that way, I also know what to do. It's like I talk about in the risk management video. You can win a horse race, but you can't beat horse racing. Meaning if I went to the track, I could probably look at the race sheet or the dog track or whatever, look at the race sheet, pick one or two that I can do my research on and beat those races, but I can't take the race sheet and win every single race down the line. I mean, the probability of that is like almost unheard of. I think there was actually a TV show that had that happen, but outside of television, it's highly unlikely. Anyhow, so the question today was, is it time to sell puts in Google? My answer to that was no. It's not, even if you think it is going to go higher, and that's because the question I have to ask you is, do you have good trade location here? The answer to, I think undoubtedly is no. You're not buying right at the breakout. You've bought after the stock is over $110 off the lows. More importantly, if you go into your option statistics, go into today's option stats, the current IV percentile of Google is 46. Anything below 50 is pretty cheap. So you're not getting, the options aren't that expensive, and you have a potential now for an outsized move. Let's say Google doesn't, let's just give the worst case scenario here. Google doesn't go up on earnings. In fact, it actually goes lower. It gaps down. What happens if it gaps down $100? It could happen. I've seen it happen with Google before. I've also seen it gap up $100. But after the stock is now up $110 off the lows, do you think that the smart money is now first buying, or are they looking to sell into the move? I would venture to bet if it gaps now into the channel high, it probably would be a short. However, if it does gap down and it's outsized of that $30, premium is going to go from being cheap to expensive, and you're going to have price and IV going against you. So I would be very, very careful. If you're planning on doing something like that, how would I go about doing it? Pretty good question. Luckily, I know the answer. The answer is you'd want to sell front month volatility, because that's the jacked one because of earnings. Like if you take a look, and I'm going to teach you guys quickly how to read options chains. If you take a look right now, the 2-day to expiration Google IV is like 54.91. If you go further out, it starts to normalize closer to about 20, 22 to 20. So what I would do is sell front month IV to sell expensive front week or front month or whatever IV to buy cheaper, longer dated premium. So that would, in this instance, mean sell the weekly premium maybe and buy some longer time premium. So if you're bullish, you would sell, let's say, 2 times the amount in the weekly and buy 1 times in the monthly. If you're bearish, you could kind of play around with that as well, meaning you would buy 2 times in the outer month and sell 1 time in the weekly here coming forward. That's a calendar play. Speaking of calendar play, before I forget, let's talk about how to adjust that SPY hedge or outright bearish bet. So I had talked about doing that in the outright in February premium. That's now 23 DTE. So I got a little creative here. I put this on like super cheap. It was like I think it was under $1. Which told me it probably wouldn't work, but I did want to have that kind of protection on regardless. And if I got to move down, it would be asymmetrically great for the play. So what I wanted to do was roll it out so I had more time. So I looked into the March premium, but I said maybe we get a little follow through with the Trump rally. Maybe they start talking about tax cuts. maybe the Fed isn't as bullish if things are going, hawkish if things are going slower. The Yellen speech the other day, which the street TV reporter said was hawkish, was actually kind of dovish. I honestly would take my analysis of the Fed over every one of them put together, frankly. So I went out to April, 86 DTE. I don't know if I got the full thing done. I have to take a look. But what I did was I rolled the call spread out, same strikes, 225, 220, and then I was going to sell. I don't know if the trade filled. I have to take a look. But I was going to sell the amount of the debit because I'm buying more time. I was going to sell another put. I was going to another overwrite. So what I was doing was, I think in the 213s or let me see, it wasn't in April. So what I was going to, I'm sorry, I want to really be very clear about this. I was rolling the call spread into April, but I was calendaring it a little bit. I was going to either roll or resell new, or should say sell new in March, the 213. So that would be 51 DTE versus 86 on the long thing. I always like to buy long dated premium and sell near dated premium. So I'd have both those February puts short of the 211s. Remember where the market broke out from, 210, 211. Not so worried about it going down there, particularly if it comes down in a straight line from here. I could also, if I get in trouble with those, either close them quickly for a gain or roll them further out. You can play all kinds of games when you have a lot of time. You just have to notice when the turn comes quickly. So in this new instance, I've shifted the long call spread, the long put spread in February out to April, sold now a March put to finance it. Why in March? Because I don't want to be out in April and all of it now, because that's a long time. If that trade gets in trouble, like if the market comes down too quickly, the overwrite will expand in terms of price. And if I'm in a near dated option, I can either roll it down and double it up or roll it out for longer dated. I know this is getting a little bit more sophisticated for people. I've been getting a lot of people asking me to kind of talk about this stuff, and this is really what I do. I mean, this is, when I talk about how I trade, this is really the kind of stuff I do quite regularly. So I hope that you guys and girls are enjoying it. So that was the plan. I think the price of the roll was like 66 or 67 cents. So that's how I just came to the March 213s, because it basically washed the buy for the thing. Now, what we have to be a little careful with here is that this is still 51 days out. I mean, the market could look very different in 2 weeks from now. Nonetheless, 51 days out. So we have to be a little cautious with that overwrite. If the trade got in trouble here, what would I do? I'd do a couple of things. One is first of all, we'd be caking on the 220 to 225, 220 put spread. What I could do then is, instead of having just the naked overwrite, would be to collar that off in some way where I could either buy downside put protection where I make that into a new spread and collar off the downside risk. I could roll it down, meaning take the strike to a lower strike and either double it up maybe if I wanted to oversell still more. I could sell upside calls. I could sell upside call spreads. There's so much option kung fu you can do when you really understand the product, the material. And I'll tell you, if you don't really understand options, and I'll tell you an anecdotal story. I did very well in college in my finance. I have a finance and marketing double major at NYU. But my intro to finance class, I remember that I took the exam, and this was like the first really big exam on options. And I remember leaving the room and was like, one of my classmates said, "Oh, how'd you do?" I said, it was either a huge success or a complete disaster, and I honestly didn't know. I was one of four people who passed well in the exam, passed the exam, I had like the fourth out of like fifth highest score, and in a class of like 200 or 300 people, maybe even more, and the rest of the class failed. And I think that really was more because of the fact that it was a very poorly written exam, but which it sure was. But I think what was crazy that I didn't know if I did well or not was because I didn't really understand options outside of the textbook. If I would have actually, with my great score, gone and traded options, I probably would have lost every dollar I had because I didn't know what the hell I was doing. Until you actually get into the game and actually trade options and see how they work, you will not be able to do anything more than like maybe covered calls or buying puts as a protection. To get into these more sophisticated things, you just got to get into, like they used to say, like you watch the war movies, they always say get into the shit, you got to get into the shit. I try to keep my broadcasts a little bit more cleaner, but I was pressed, so I try to come up with something a little bit better. Just try and play around with these scenarios. Look at what works and what doesn't work for you, and do more of what works and do less of what doesn't work. So my beef with, like I said, selling the puts, and I'm not saying that Google won't go higher, and I'm now bringing it back to Google now that I think we covered the SPY. If there's any questions, you could type it in. But the problem I have is that it's moved up a lot, and you'll have price and IV going against you. If you wanted to be the put seller in Google, like let's say that's your style, the day to have done it, in my view, was on 1/6. That was the break of the downtrend line. You had multiple days of consolidation, and where was your stop? Your stop was below that day's low if it went badly, because that would have been a false breakout. And what you could have actually done, if you were short puts, either bought them back for a loss or made it a put spread, a bearish put spread. Like if you were short out of the money puts, you can buy an at the money or some kind of strike near it, and that's the kung fu. You flip it from a bullish play to a bearish play. Or sold upside call spreads, bearish upside call spreads. There's a lot of ways to, I don't want to say that it's plenty of ways to skin a cat, but there are. So that's my view on Google. If you're going to play it long, let's say you do think we're going to see the channel high, or we are going to see the 1.618 Fibonacci extension, do it, in my view, better still. Now we know that I discussed that IV is cheap. Buy the calls. I would buy a call spread, frankly. If you think that's expensive, what you could do is buy a longer dated call and sell a near dated call against it. So you'll have money, figure out where you think it could go or won't go, and you can play it that way. If you want to keep it straight, straight poker here, do it in the same expiration. Buy a call, sell an upside call. You could also turn it into a fly, meaning buy call, sell two or one. It depends on how you want to do your butterfly, and then buy a still further upside call, and you're kind of playing for a move into that range. It's usually a little bit more sophisticated. I've had some varying success with that type of a play. I usually like to keep it simple, stupid though, with just a straight out spread. There was something I wanted to say about that just escaped me for some reason. Crud. Anyway, if I think of it, I'll come back to it. Let's fly through a couple of these stocks that we all want to discuss, that you all wanted to discuss. First and foremost is Apple. I'm just going to go down this list. I'm going to try and get the ones that I'm more familiar with, that I'll spend less time on, and then what I'll do, and what I did in last week, is circle the ones I'm a little less familiar with and cover those in the weekend review video when I have a little bit more time to review those charts. So I'm not kind of reconstructing the Abbott. Like this uranium one that someone asked me about, I don't really follow uranium that often, but I could always, you give me a chart, I can take a look at it. Apple is also kind of breaking out ahead of the number. I don't love when these stocks run into their prints. It's right on the backside of it's been kind of riding an upside regression line. I'll keep it real simple. As long as it holds over 120, basically, the path of least resistance is higher. Back below 120 is more iffy, and maybe even a right or right out short. So that's real simple on Apple. There have been some downgrades. There have been some attempts to take the stock down. Skyworks Solutions, which is a major Apple supplier, reported good earnings. So what I would suggest is if it does keep running into the number and you're long, you might want to book some profits. What you could also do, and this is again a little options kung fu, and I love to get into this more around earnings because you could do so much more with it. If you're long stock, I know a lot of people are long shares. What you can do is turn it into a synthetic butterfly, and that's one of my favorite earnings trades when I have shares. So I have my shares. Let's just use 100 because it's the most basic one, or 1,000, whatever you want to use. Let's just keep it simple with 100, because that 100 shares is the minimum for basically for an option. So you have your long shares. What you would do is you would sell an upside call. Again, you'd want to do it maybe in the weekly because that's where the IV is jacked. And then you could use that as part of either all or part of that premium to buy either, that could be your hedge outright. You could use that to buy a put spread, a downside put spread, which is fine. So you'd sell the call and then finance it by buying, a put spread, meaning you buy a put and then sell one that's still lower. Or you could use part of that premium to buy a still further upside call. So you're selling the near dated jacked up premium that's hopped up because of the earnings, and you're going out further to buy a longer dated call to the upside. So if you lose your shares, meaning you're called out of those shares, you still get some of the cream as it rises from the longer dated call. In this example, and I'm going to give a quick one, Apple IV is next week is 28. In March, it's only 19. That's so cheap. So what I would suggest doing is, like, let's say next week you would sell, or you could sell, like, let's say 125 calls, meaning, and you get like a little less than $1 premium there, but 125 to 127 is some past resistance. And then like you take that and you buy, let's say 130 calls out in March. So you'd still get some of that upside. And if the stock goes up, what you could do if you want to take it to the next step is turn that longer dated upside call into a call spread. So let's say for this hypothetical Apple, let's say it gaps to 130, for example. It's at 121 now. Let's just say they blow the doors out of this quarter. So you are out of your stock, right? Let's say in this instance at 125 because you sold that call. So you basically get 125 plus, if you were to have sold it today on the close, it would have been 89 cents. So you basically get 126. So you're down, you don't benefit from that additional upside. However, you were long that 130 call from in March. So what you could do is the fact that you lose your share, you could either outright stay long your call or sell, like, let's say the 135 call, and you turn that into a call spread. There's so much stuff you can do with options when you really know how to play with them. And this is how I play. This is the way to do it. And you increase your probability of success so exponentially. So that's my view on Apple. Long story short, 120, I like it long. Above there, I mean, below is a little more iffy. And if it runs hard into the number, I'm a little not so thrilled. My favorite earnings play, and it's still time, there's still time, is that there's a shake and bake. Meaning Apple does come back below 120, shakes everyone out, has some kind of nasty dump, and then it sets up for the long. I love this with stocks that have some kind of a sharp, fearful pullback ahead of earnings, and then set up for the long. So it's the shake, meaning the down move is the shakeout, and the bake is the rally. If you ever hear anyone use that term, by the way, ask them where they got it from. If they don't say it's from me, or ask them where it is from. Then, it's obviously from it's my joke from Talladega Nights, the story of Ricky Bobby. If you watch me, you'll often hear me quote movies, but that's where Shake and Bake is from, for those who are curious. TLT, this is one I was watching keenly. I actually had played this pretty well. We had one stop out, but we got back in the saddle, and we talked about it 123.15 being target. We got 123.14, and I talked about being a stop out below 123. Holy cow, was that a good call. I didn't expect this thing to come down almost as hard and fast, but it did, and we are now below the Fed day high, which is 119.21. Anything below there, to me, probably puts a retest of 116.80 and maybe finally, at long last, we get the full channel low trend retest around 114.88. Do I know that's going to happen? No. But I will say this. We are below the 50 MA, which is a little iffy. We are below the Fed day high. Fed day ranges are really key. If we were to get above today's high tomorrow, or whenever, then to me, particularly tomorrow, it would have been a look below and fail, meaning a look into range and price rejected higher, and I think you could buy stop it over the high of day, which is 119.60. So if you're looking for like a trade here, I either like a put spread or more likely a put ratio for a move down to that trend or the retest at least of the old reference low, or a buy stop over the high of day, meaning you could either get long or stop at your short over the high of day. So that's my view on TLT. The curious case of Qualcomm, I meant to talk about this one in the weekend review video, but unfortunately I didn't. That was very annoying. So on the big dump day, I sold some puts in this sucker. I didn't like how it was acting yesterday, and I took them off. Today, I had talked about a quick write or write out trade for a move over the high, but in after hours, Qualcomm they reported earnings, and the stock is down. Is it still down? Let me see. Yeah, but it's not down a lot. So I like a couple of things about that. One is first of all, they're probably going to get a ton of downgrades tomorrow. I want to see how they handle that. If the stock cannot go down on bad earnings, meaning like it's green tomorrow and it holds, buy the stock and use the after hours low, or actually the opening 15-minute range low as a stop. So let's talk about how to actually trade Qualcomm tomorrow. If we get below the after hours low of 54.80, it's probably going to be a short. If, for example, the stock gets opens up and it doesn't take out that low and it takes out the 15-minute opening high, I think the stock could be a long. In this instance, I have an important number on this last intraday swing. After hours was 55.84. Anything above 55.84 probably should go higher. If you get below the 54.80, it's probably going to go south in a hurry. Where could it go? 53.46 is the 61.8, and there is actually, I know this is going to sound really extreme, but there's a gap fill down at 44.56. We know Apple is suing Qualcomm. That big dump day was a really, really big volume capitulation day. I think so many people got their bells rung in this that it probably took out a lot. First of all, the pattern was setting up really bearishly, and this gap took out the channel. It filled the gap and almost got the 61.8. I was actually hoping it would have. Oddly, my option filled as if it had. But you got to get over that either today's high. I think over today's high would be an add, but if you can not take out the after hours low and over the opening 15-minute high, I think would be a long. If you get below the after hours low, it's either a no touch or a write or write out short with a stop over the 15-minute high. So that's the way to trade Qualcomm. But if you're really going to play it long, you really do want to not see it take out the after hours low. I find that, by the way, is a really interesting trade quite often, that setup. If you go back to my original video that I posted way back a couple of years ago when I first started, video number 1, I go through this in detail with Apple. That video, obviously it's not relevant price-wise to Apple anymore, but if you go through the methodology, that will teach you how to play these types of setups. And that trade, by the way, worked out. We got in at the absolute dead low on that move on Apple. It was really a thing of beauty, if I do say so myself. So I'm going to jump around a little bit here with regard to this stuff. Let's talk about the dollar quickly. The dollar is looking like it's setting up, believe it or not, for almost like a head and shoulders type of pattern. I don't know that will be the case, but it's possible. we haven't built out the right shoulder, so there could be a rally up to the 102s again. Anything below 102 to me is still very iffy. If we get through 102, I think we're going to 109, and I think it's going to be a really ugly situation for international companies. We'll get to that when we get to that. But you have 100 MA that's creeping up. Anything that really holds 99.49, like 99.5, if you want to try a right or right out trade with like a sub 100 MA stop, that's fine. If we were to lose that, I think we would be looking at the dominant trend and a test of the channel low, which coincides with the 200 MA down at 97, where I would also be interested again in a right or right out trade. Oddly, the best thing that could happen is no bounce on the 100. The thing goes straight to the 200, and then that would set up, it would be so oversold at that point that the thing would be an absolute screaming setup. However, if we are to do the neckline test and we are to hold, it would probably be about a 100 MA test and then a bounce to maybe the 102s. The ideal scenario in a head and shoulders is for the right shoulder to be lower than the left. Then you get the translation lower. There'll probably be some kind of a check back to the neckline, and then the thing would either collapse. So those are the kind of the three or so scenarios I see as being likely in the dollar. PayPal, they report. I don't think do they report tomorrow? I'm short a bunch of puts in this thing. It looks like it's up after hours. Did they report? Yeah, no, tomorrow after the bell. Why is it up after hours? I have to take a look. Oh, eBay. Okay, eBay reported. A lot of people. Wow, this is a huge mistake that I can't believe that I actually just made, because I've warned people about this in the past with PayPal and eBay, that they still kind of trade a little alike. So always keep an eye on that, and I'm going to give myself a nice smack on the wrist for not checking that out. But eBay reported it's good, and that's why PayPal's up. PayPal, by the way, is possibly one of my favorite stocks to buy on dips. Anytime it gets into those mid-30s, it's a buy. This thing, I just feel it is destined for much higher. I've traded it fairly well. You really need to hold 41 to 41.5 for the higher. Below there just gets to be choppy and range again. And I like selling puts on this thing when it does get smacked up. Tesla, let's cover that quickly. I'm a little leery about this breakout because it has come up from the bottom, and 265 has been really, really hard to get through. Let's see how that handles itself. Yesterday was the breakout of trend. So if you're long, I think it's a good idea to book some profits in this close to 265. I assure you that's a really important level. If it does get through it, I'll discuss where the range extension can go, because I do think we would get up to the old all-time high. But the more this rallies ahead of the print, the more the shorts are squeezed, I get a little bit iffy. Sorry, I got a little dry here. Twilio, not one I like very much. I had talked about these being the new silliness stocks. If you go back to past weekend videos of mine, I was bullish on this stock, and I talked about it getting to 265.94, which was 2 times the range, and I said it would be smart never to look back. I did, however, dip the toe again when it did break trend, and we thought we would get a retest. It actually went higher than I thought, but I said that I was no longer bullish on the stock. I was poo-pooed. These are the same people who were telling me Fitbit was a buy at 46, the same people who insisted that that GoPro wasn't a short at 96. I bet they wish they listened. The stock has been awful. I don't hate it as much down here, I will say that, but below the 50 MA is still iffy. And they have another lockup coming up with the stock. Someone told me the other day, I don't know if this is true or not, that the CEO blew out of every single share he owned. I don't know if that's true. If that's true, I wouldn't touch this thing with your money. I could have used some other colorful terminology for that, but we're going to keep it a family show. But below the 50 MA to me is a little iffy. It's roughly around it's kind of above the 10 and the 20 MA. If you're currently long, you could use those as your stop. but I wouldn't be looking to add to this thing until you get above and close over the 50 MA. It does look like, I will say this, it does look like it's trying to bottom, but I would use really small size in this thing, and they do have earnings coming up. I think that if it gaps up on earnings, there's so much supply in this thing. I don't know. I'm not a big fan of Twilio. I will say this though. I have nibbled a little bit on Fitbit and on GoPro. I was lucky that GoPro I bought I think at 9.5 and it gapped up really nicely yesterday. But again, just testers and just assuming that these things aren't going to be quite zeros just yet. I'm not a big fan of Nick Woodman. He is the CEO of GoPro. I got real bearish on that stock when they prematurely unlocked their shares. That to me was a big no-no. I remember I was super critical of the FireEye CEO for doing the same thing, and it to me seemed like going to be the exact same situation, and it was. When you see stuff like that kind of shenanigans, you know it is time to go. But I am trying a little long in GoPro and Fit. I actually bought a new Fitbit. I upgraded my Charge to the Charge 2. So now I'm balling, right? I got the Apple Watch 2 and I got the Charge 2. I like the Charge 2 better, believe it or not. I find that it's easier to wear around the house. It has the notifications. But if I'm in the car, then I use the Apple Watch because I could speak texts. So it's sort of I'm a dual. It's crazy. I used to actually have an iPhone and a BlackBerry. So it's not unprecedented that I have two rival technologies. Not that was really relevant, but it gave my brain a few seconds to discuss. Mattel getting nailed after hours. Kids, if you go on airplanes, they're not playing with Barbies. They're playing with iPads. It's a long-term trend. I had been long this a while back. I was underwater, and then I took a gap up, and it got me out, and I never looked back, and I had collected some dividend there. So it wound up working out, but I just don't like these kinds of stocks. If you're going to do one, I prefer like Hasbro. They get like the movie action figures, like the Transformers and Star Wars and all that stuff. So that's the story with that. Let's just blow through some more of these. The BABA, I think BABA didn't hold the gains so well the other day. They had a pretty good quarter, but it was because a lot of people were long, and they were long in the weekly like call type of situations. But it still looks okay to me. It was technically a gap over the downtrend, and now we're over that high of day. So anything over 103.19, I think keeps 110s in play. So that should, all things being equal, fill up the triangle back up to that close to 110. So I'm fine with that. If you start getting back into that range below 103.19, it's a little more iffy to me. So that's the BABA. Facebook, someone asked. All right, so I have a couple of thoughts on Facebook. This was also one that I had talked about getting out at 128.33 and 130.43. It got a little higher, but we never looked back, and the thing went down. I don't love that it filled the gap ahead of the earnings. It has sort of poor lows. It's getting close to the backside of the old uptrend and the all-time high ahead of the print after running off of a low from what was this low? 113. So it's moved almost $20. So my thoughts on this is that it probably will at least retest the old high and maybe make a new high. But it'll have run so far so fast, I would use that opportunity, I think, to book some profits. I really want to hear the quarter. Last time they lowered their growth expectations, which got me very cautious in Facebook. I had talked about a couple of quick trades in it, but on the whole, I haven't been really as long Facebook as I had been in the past, which I think at some times actually were quite scary how long I was Facebook. I probably, if I ever really thought about it at the time, I probably wouldn't have been sleeping very well. But that's my take on it. I really want to see the quarter. If it's good, this thing could see 150. It's very possible. We're a long way from the progression line, which is, if you guys remember my old videos, really up at 145 and 145s. I mean, this thing could could move. We could be talking Fibonacci extensions of the down move. Actually, why don't we do the Fibonacci extension of this recent leg? If we were to do the Fibonacci extension, the 1.618, oddly, is 145.83. So, yeah, it's crazy how I came up with that. Sometimes that's just how we roll. So I do think if we get through the high, this could potentially see 145, but I'll be a little leery because it came up so much into the number. So a gap up could wind up being a sell opportunity, but 145 to me would be an upside challenge. I would be an interested buyer on this if it did pull back to, let's say, the... I would love it if it pulled back to like the 200 or the 50 MA, but probably the 100 MA might be all we get. This would be a great shake and bake candidate. If this were to come down some ahead of earnings, I'd be a little bit more interested in that. But I'm a little leery about Facebook the higher it climbs into the print. Someone asked about FFIV. Not one I trade very often. Let me look at this chart. They're reporting soon, right? No, did they report? They already reported. How did this stock do? Let's see. They had $1.52 estimate. They blew it out with $1.98. What is the stock doing? Let's see. It's getting smashed. So they couldn't go higher on good numbers. That's never a good sign. Did they have a guide down or something? Something must have been not kosher in that name. It's now coming from a lower high. I'd probably be interested if it filled the gap down to 119.51. Is that right? No, 119.54. Somewhere between there and the 200 MA could be interesting. What's the after hours low? Damn it, let me go back in. 5 minutes. It's still much higher. I'll tell you what, let me circle FFIV. I'll come back to that one in the weekend review. That one should be interesting. Someone asked about Target, not one I follow that often, but I'm glad it had a bit of a bounce. I think that I do think at some point, I don't know when, but I do think that there is going to be some regulations coming to Amazon. We'll talk about that at some point, probably after their earnings. But this has basically a double bottom that held, and you had a gap up. So as long as you're above today's low of day, I'm fine with playing that for a long. I might actually put something on in here myself. You had a look below. There are two trend lines I have drawn in. Let me go back to a longer chart here, because this one might be one I'm interested in trading. Seasonally, I'll talk about this. It's not the time for retail, and Kohl's and these have been awful, terrible. I would be more interested in this, honestly, closer to about $60, or down near a fib, which is near the old all-time low, around 55. I'd probably be looking to sell like 48 or 50 puts if it gets jacked. These tend to bottom in the late August, in the summer. But I will say, if you're looking for a quick trade, I like it had equal lows and a gap today over the. Let's just use today's low as a stop. Anything below there to me gets iffy, and you probably could short it. But as long as you hold today's low, which is 64.66, maybe there's a bounce to the 10-day. Seems like where there's been some resistance, that's where it broke down from. That's where it would probably rally up to. It's currently 67.36, so we'll circle target. Maybe we'll cover that one in the weekend review. Starbucks. Speaking of which, that cafe trade worked out perfectly. We got out at the 50% fib. I was going to be greedy and wait for the 61.8, but I said to myself, Self, you're being a little greedy, and I booked it. We did it in real time, and no sooner than that, it went down quite a bit. It started coming back up too. So let's look at Starbucks. Oddly, Starbucks is rallying, with coffee rallying. That's a little strange. Starbucks is looking a little bit better. It filled the gap, though, and it came up a lot. I don't know. I'll tell you this. If you lose, today it was a doji, too, at the gap fill. If you lose the low of day, I like it for a right or right out short below 58.45, and that would be from a lower high. I'll tell you, when stocks come from all-time highs, I don't really like to short them until they make a lower high. That's just been how I operate for years. It's been when something comes from the all-time highs, they just actually this actually is from a lower high. It had a head and shoulders. It's eaten a lot into that. I'd be a little leery here. It is over the downtrend. I will acknowledge that, but I would use today's low of day as a stop if I were long, for sure. If it keeps going, it keeps going, but I would use low a day. And if you're going to be wanting to give it more wiggle room, the 10-day is to me a must. You have the 50, roughly around 57. If this pulls back to there, which is the low end of this range, you might want to sell some out of the money puts. But Starbucks, I'm a little iffy on, honestly. I've been a little leery about them for a while. I don't love that Schultz left. I don't really particularly like Schultz or his politics, but he is one heck of a CEO, and I do acknowledge greatness where it exists. So without him, I do think that the company is slightly diminished. I'm sorry, it is. I wanted to do more, but we're already over an hour, which is not good, and we're going to cut it there. If you want to watch the video, if you missed some of it, I think this was actually a pretty good video. One of my more in-depth ones, it's going to be on my YouTube channel shortly. I'll post it, and that is Justin Pulitzer Trades. If you're not following me on Twitter, my handle is @JustinPulitzer. Anyhow, have a great rest of your week, and cheers.